Good morning. My name is Gad Levanon, and I'm Chief Economist North America here at the Conference Board. Welcome to our March edition of Economics Watch. I have two distinguished guests with me that I'll introduce to you in a minute. Let's start with what's the main thing we're going to talk about. The topic is a gear shift, the Fed inflation and interest rates in 2019. There were a lot of developments in those topics in recent months that we wanted to discuss, and what happens to those economic factors will have an important impact on all of you in 2019. So we thought it's worth spending a webcast on that. Here are some of the questions that we're going to discuss beyond the regular monthly outlook. Will Federal Reserve monetary policy boost business confidence and investment now that the Fed essentially suggested that they would not raise rates much, if at all, in 2019? Why has inflation stayed under control in a tight labor market? Can business count on few, if any, rate hikes in 2019? And how will interest rate movements shape consumer demand and business investment trends? So those are some of the topics we'll discuss. As usual, there are CPE credits for this webcast. So if you're interested, type your full name and email address in the space provided. Click OK for 3 pop-ups during the program. You need to be online for the entire webcast, and the credit is available for live participation only. Of course, also to remind you, if you have any questions, you don't need to wait until the end. You can type them as they come. So together with me, two regular guests in the webcast, Ataman Özildirim, Director of Economic Research and Global Research Chair at the Conference Board. Welcome.
Good morning, Gad. Good to be here.
And almost every month, Brian Shatkin is here next to me. Good morning, Brian.
Good morning, Gad. Very excited to talk about the full complement of first quarter data now that the first quarter is nearly over.
Yeah, the shutdown did some changes to the schedule. So let's start as usual with the global outlook. Ataman, before we before we tell you about the outlook for the globe, let's see what you think. We have an audience polling question for you. How has your firm's outlook for international profitability evolved since the beginning of the year? So compared to a few months ago, did the outlook become much stronger, about the same, weaker, much weaker? Let's give you a few more questions, for a few more answers. Okay, let's close it in 5, 4, 3, 2, 1, and we closed it. So, well, all the answers went into either about the same, where we got the majority, or stronger. Brian, Ataman, any thoughts on that?
I think this is pretty consistent with the idea that going into the year, there was an expectation that Euro area and Chinese growth would indeed slow. I think that expectation has mostly been realized, which is why most firms view profitability at about the same level as they did entering the year. There is a little optimism, perhaps because of the fact that the Fed did announce this rate shift. As a result, there are higher growth expectations for the U.S. than might have otherwise been the case, especially later in the year, as we'll get to. And the end result of that is maybe some more momentum for global growth.
So I thought this is very interesting. It's more positive than I would have expected, based on what we're hearing from sentiment surveys. About the same. It's been fairly good, and then there are some people that are expecting a better outlook from the international front, Whereas, if we're looking at our own projections, we're seeing moderation or a slowdown in emerging markets. We'll get to that in a minute. But more importantly, I think in the fall, we saw much more concern about a global recession. Our own C-Suite Challenge survey showed that it was the top of mind for external concerns among CEOs. And there was another CFO survey in the fall that they were also concerned about recession risk rising. And we'll talk a little bit about the recession risk, which is out there and people are talking about it. But as economists, we like to look at the facts. And when we look at the facts and when we look at our leading indicators, while it's not clear sailing, the recession risk for an immediate downturn is not being signaled when we look at the economic indicators. At the same time, the business cycle is or has reached a mature stage. So we're out of recovery. We're into a mature, latter stages of the business cycle when labor markets get tighter, wages have upward pressures, there's more inflation in the horizon. And the surveys about sentiment might be a reflection of this, that executives are feeling a change in the air, and there's a reaction to that change and maybe an adjustment to a more slower outlook going forward. So that adjustment gets reflected in these surveys, which reflect more pessimism that we've seen. But it looks like maybe that pessimism is going away because the Fed has kind of changed its stance in terms of monetary policy. It's become more accommodative. Other central banks around the world, the European Central Bank has also signaled that they will wait. So that provides more accommodation and maybe reduces the nervousness about the outlook. So that said, there is no signal of a synchronized downturn, even though the business cycle is maturing. There are sort of fundamental strengths in the economy going forward, especially about the U.S., as we'll see later. But around the world also, there's no significant risk, although some of the risk has been elevated in some places. The concerns that we see seem to be more idiosyncratic or country-specific rather than a widespread global slowdown. So when you look at individual countries, there are issues such as in the US, the tax stimulus is going to be fading in 2019. Europe is retreating from a strong recovery because the global trade has been slowing down, partly to do with China kind of slowing. Emerging markets have their own exposures on the global market. The strong US dollar, rising rates in the US is kind of shifting the financial flows away from emerging markets, so that creates individual problems there. But so these are more idiosyncratic, and it's not a widespread synchronized downturn signal. At the same time, the labor markets generally are doing fairly well. That supports the consumer outlook, and consumers, as we'll see, remain at pretty high levels of confidence, and that supports the overall economy. But some of the risks are getting elevated, and when we look at where the triggers for a recession might be, so here you see sort of the three that we think most about, and it's that the trade disputes could impact some sectors that are leading the economy, and that could create more concern about slowing, especially from global trade. And indeed, there might be more trouble in the industrial or manufacturing sectors. So some of the reaction or concerns that are becoming elevated that we see might be a reaction to a slowdown in manufacturing. But especially in mature economies, manufacturing is a smaller share of the economy. So really non-manufacturing and services is driving, and there's not a major problem there. Brexit could be an issue, especially if it's a no-deal Brexit. And But that remains kind of a European problem that wouldn't spill over to other countries. And as I mentioned, at the later stages of the business cycle, factor costs are rising. So more pressures upward on wages, cost of capital, and that does bring some pressure for corporate profits, and that could affect the outlook for business spending and especially investment spending on equipment and machinery and new technology. And that does take some pressure off the growth outlook.
Now, Adwan, we have the fourth quarter information on our global consumer confidence, which is a new survey that the conference board conducts. So what can we learn from that about the global outlook?
So as I mentioned, consumers are feeling fairly upbeat, especially in the large economies like US, China, India, and Germany. Their confidence levels are pretty high, and that's what you see on the left side of the map here. So the brown and red colors are showing where confidence levels are pretty high. The blues are where they tend to be lower. And those economies like Argentina and Russia have a smaller share of the world economy. Mm-hmm. So relative to the larger economies, their impact on the overall economy is less. So from this, we could conclude that consumers overall are feeling fairly optimistic. That helps to support spending levels. Now, the right side looks at the change in consumer confidence relative to the previous year. And in that case, green is good because it means there is an increase or an improvement. And the reds in this case are where there's a decline. And the declines are you're seeing where confidence levels are low. So that spells more problems for the consumer sector in those countries. One thing that we should mention is that this is based on an online survey in these countries, 65 countries. And so it represents the connected spenders or the connected consumers, which for many of these countries is a large share. But it does kind of looks at a slice of perhaps the middle class and the upper class consumers that respond to this survey. But overall, consumers are fairly optimistic, and that supports the outlook.
Ataman, I'll take advantage of the fact that you're Turkish and mention here that Turkey is one of the countries that had the largest decline, and also headlines this week that Turkey's entered a recession. Can you say a few words about the conditions there?
So the economy there has been a trouble spot. Mm-hmm. Again, it's probably more tied to the problems on the political and economic side specifically for that country, rather than reflecting an overall problem for the world economy or emerging markets. But because of the sort of fragility of the political situation and some of the institutions, rising inflation as a result of a huge sort of depreciation of the Turkish lira, took away a lot of the sentiment or optimism about the economy. And so that's compounded by the fact that the changing tide towards US and mature economies and financial markets also created a less supportive economy for financing loans, finding funding. So I think it's a reflection of that environment that's very specific to that, rather than being sort of the canary in the gold mine, for the world economy.
Brian, is it a gold mine or coal mine? What's the right phrase?
It would be coal mine, because the canary can help detect future risks.
That might be wishful thinking. Looking for a gold mine.
So, Ataman, what are our leading economic indexes are telling us?
So we follow 13 countries around the world for these leading economic indexes, which are future-looking indicators that summarize the business cycle. And they look ahead 6 to 9 months. And in this graph, we're looking at a global aggregation of these LEIs. And when we analyze the movements of this, we can kind of divide it into these four quadrants from expansion to slowdown to contraction to recovery. And most of 2018, the global LEI was firmly in expansion territory. But towards the end of the year, in the fall and through December, the last data point that you see here, it has moved into slowdown territory. So this is what the facts are telling us. There is a slowdown and moderation developing, but it hasn't moved into contraction yet. So this spells sort of for 2019 a slowing, moderating growth outlook, but no elevated risk of recession that's imminent in the next 6 or 9 months. So when we think about recession risks, we're really now looking ahead to 2020, whether that will develop or not. Mm-hmm. And we can look at the country breakdown of these indicators too. And the flags here show the latest observation for the 13 countries. The major trouble spot is the UK, where the LEI has been trending down for quite a while, over a year, and it has put the LEI for the UK firmly in the contraction territory. And the others like Japan, Mexico, Australia, and Canada are closer to contraction territory. But keep in mind, these are monthly numbers. They can be noisy. So the previous chart, which shows the aggregation, is going to give us a better handle on the recession risk for the overall global economy. Although the individual country outlook does vary, and as I mentioned, the UK is probably the biggest problem spot where I'm concerned about a recession, and we're seeing sort of that playing out. And GDP is kind of drawing to a halt, and then it's not being helped by the Brexit situation.
But I think what this chart usefully illustrates is that there's a clear direction of travel that was also illustrated by the global LEI chart, which is a movement from that top right quadrant, the expansion quadrant, into the slowdown quadrant, with some economies threatening to move into a contraction quadrant. And so I think what that direction of travel illustrates is that different economies are in different places in terms of what their level of contraction risk is, obviously with the UK being the most accelerated, and also facing a situation where it's pretty clear from current economic conditions that growth is also nearing zero based on recent GDP releases. But you have seen since the middle of last year a general lowering in terms of future growth expectations across all major economies to different extents.
Right. And as we say, every recession is preceded by a slowdown in growth rates, but not every growth slowdown leads to a recession. So sometimes you see these economies moving towards slowdown and then moving back into expansion. And that a lot depends on the external environment, the policy environment, and to the extent that monetary and fiscal policy becomes accommodative and stimulative, that can help to avoid a recession. But in some cases, at slow growth rates, it's easy for economies to tip into the recession territory if there are both cyclical and structural factors that are at play that are pushing the economy down.
Mm-hmm. Thanks, Herman. We also updated our global outlook. So what are the main changes there?
So generally, the balance of the revisions are towards lower growth in 2019, and kind of see the breakdown here. It's both a slowdown from 2018, and our initial projections for 2019 were also taking down a notch a little bit. So we see mature economies growing about 2.1%. That's US, Europe, and Japan. And that's lower than the 2.3, 2.4% average that we saw last year. Emerging economies are also down a notch from 3.9 to 3.7%. A lot of that is being driven by slowdowns in China and in India. And that kind of brings down the world average to just about 3%, which is a good growth rate, but it's very difficult to kind of go back to the 4 or 5% environment. So going forward, both in the next year and the next 5 years, we're faced with a more moderate growth environment. So one last note on China is that while we expect a moderation, we also expect that the government will step in with stimulus measures to offset some of that. So the activist government policy in China is expected to slow down the slowdown. So that helps to support Chinese growth, but it does support growth in trade and growth in Europe and Germany as well.
Ataman, can you elaborate a bit on the outlook for India? Because some of our viewers think that even this revised figure may be a bit too rosy. In light of the upcoming elections, what kind of further downside risk might there be? And what is the cause for keeping growth expectations at around this 6.9% number for next year, for this year?
It is a relatively high projection, mainly supported by the consumer outlook, and their inflation outlook has been controlled. So that's generally supportive of a continuing expansion, and that's what's reflected here. But as you mentioned, there are risks kind of in the outlook coming from the political side, really, with the elections creating some uncertainty going forward. And the recent clashes between India and Pakistan also would undermine confidence, and that also can have a knock-on effect to spending plans and hold back investment and spending.
Great. Thank you, Ataman, for great global outlook. We are now shifting to the US. And before we tell you about what's happening in the US, let's hear from you. A somewhat similar question to the question we asked before, but this time focusing on the US. So how has your firm outlook for US profitability evolved since the beginning of the year? Again, much stronger, about the same, weaker, much weaker. I'll give you a few more seconds to come up with an answer. So 5, 4, 3, 2, 1, and we are closing the survey. So first of all, we have a few more voters. I guess when we asked the first question, not everyone was already logged in. So I don't know if that's the reason for the differences in the answers. For those of you who came late, when we asked the same question about the international profitability, all the answers were either in stronger or about the same. Most of them were in about the same. And here we are seeing close to 30% who are saying weaker or much weaker, and only 5% saying stronger, and none of them saying much stronger. So, Brian, what do you think is why is the difference between those two answers?
So I find these results fascinating because on the one hand, you have a large majority who believe that profit expectations are about the same as they were entering the year when markets had gone down by about 20% from peak levels. The US government was shut down. There was a lot of concern about further monetary tightening. As we'll illustrate, many of those concerns have definitely eased, but yet, in general, you don't see increased optimism. On the contrary, if anything, you see increased pessimism and concern. Maybe some of that's a result of rising labor costs and concern, and the fact that, in addition, inflationary dynamics are not particularly supportive to giving firms additional pricing power. But I think those results are really interesting, that despite the Fed policy action, it doesn't seem like there is increased confidence in the outlook for growth and profitability.
Yeah, and that is Ataman. Any thoughts here?
Well, I think that's fairly consistent with what we're seeing in the numbers as well. Maybe if we asked this, last fall, there would be even more pessimism. But about the same is, three forces saying about the same, and that would be consistent with the economy kind of returning to a trend growth rate with not much upside. But I think the weaker responses are showing that we should watch out for those risks.
Yeah. No, I certainly think that a year from now, corporate profits would be weaker than they are today. I think we have a combination of slower revenue growth and faster labor cost growth working here. And that's under the assumption we don't get into a recession. If we do get into a recession, profits will plummet for sure. So I can see why there isn't that much optimism about profits. So Brian, let's get back to the slides. What's our outlook for the U.S.?
So I think our outlook has shifted in the following way since the beginning of the year. Our perception going into 2019 was for not a gradual step down, because it would be a pretty significant step down from what was above 3.5% average growth in the second and third quarters of last year, but that Q1 and Q2 would be demonstrably stronger than the later quarters of the year, because government stimulus from last year's spending package would be playing more of a role, and some of the labor and capital constraints that the economy will eventually encounter and will drag growth back towards 2% would arrive later in the year. I think what we're now looking at is that Q4 growth was relatively weak at 2.6%. In addition to that, a lot of the reason why it even reached that 2.6% number was that inventory runoff did not occur rapidly in the fourth quarter. In part, that's because of weaker than expected retail sales numbers. So companies are going to have to pare those inventories down going into the first quarter. There's some evidence, given January retail sales numbers, that Q1 growth, especially from a consumption perspective, could perhaps be weaker. But looking out into the year, I think a lot of the headwinds that were most concerning have eased. The government shutdown did end. It became the longest shutdown in history, but after 5 weeks, it did conclude, and there aren't near-term prospects that it will resume. Most importantly, the Federal Reserve signaled a willingness to adopt a much more accommodative monetary policy stance, to wait until there is clear evidence that inflationary pressure had risen before raising interest rates. And also, there's been somewhat of an easing in terms of trade policy uncertainty that we'll have to see how negotiations between the US and China play out. There still are significant headwinds. The general slowdown in global growth, chief among them. But we have seen that since the Fed policy announcement, since the end of the shutdown, consumer confidence measures have bounced back in February. Service sector business confidence did. Manufacturing may be a little more concerning because there's more exposure to the global economic environment. There's also more risk that because interest rates have been higher than they were in the past 5 or 6 years, that some of those big ticket purchases, including automobiles, and this may also be affecting the housing sector, have taken a hit. But I think clearly the Fed action has helped restore market confidence. It's helped restore business confidence. The question is, given how tight the labor market is, given wage growth now clearly above 3% across, I think, all major measures, will those higher wages be passed on in the form of consumer prices? And will, in the end, that force the Federal Reserve to consider raising rates once or twice during the second half of the year? So, looking at the overall growth picture, what this shows is that you can see in the second and third quarter just how strong growth was last year, and that you have a rapid deceleration down to around a 2.5% rate between the fourth and first quarter of this year. And then we expect from there a gradual slowdown back towards that 2% trend. But because there's more confidence, we do expect some more investment to be in play, some more spending. So you're not going to see weakening there. Instead, the weakening is more going to come from that red area of the chart, the government spending, whose influence is going to be pared down, as well as the need to pare down inventories as well. So, Gad, I think the labor market becomes a huge question in terms of our outlook, because what's happening in the labor market has such important implications for what may happen in inflation and Fed policy. So what has happened in recent months?
Yeah, in recent months, the labor market continued to tighten and wages continued to accelerate. We had a bit of a surprise in February where employment grew by only 20,000 jobs, but that was probably a bounce back from the increase of more than 300,000 in the months before. So I think the average of the two, around 160,000, is probably the current trend of employment growth. That is more than enough to continue to tighten the labor market, because there is almost no growth at all at working age population with the huge retirements of baby boomers. So as a result of the tightening labor market, wages are accelerating. We're seeing here the two main measures already above 3%. In this is what we see here is kind of to smooth it. We made it over a long period of time, but if you look at the most recent months, we are even at close to 3.5%, back to pre-recession rates of wage growth. And that when it's growing so fast, something got to give. Either companies will suffer in terms of profits, or companies will raise prices. That's why there is some concern that at some point inflation will pick up. But certainly the outlook for the labor market is more of the same, more tightening and more wage growth moving forward.
Now, given what's happening from a wage growth perspective, how is that going to impact consumers?
Wage growth should give more. It is giving more money to consumers, so they should be able to purchase more. But at the same time, we have other factors impacting consumer spending, and we see. We know that in the fourth quarter of 2019, there was, especially in December, but also in January, we had a very disappointing retail sales numbers. I would say even shockingly low in December. The drop from November to December was extremely unique. There was some recovery in January, and we can see also that happening in the consumer confidence measures. But there was, I think that those are a few traumatic months for the US consumer, the combination of shutdown, of the huge drop in stock prices in December, of the growing concerns about trade war with China. That's around the December, January, that was the peak of those concerns. And that took a toll on consumer spending, probably. The question is how much we will see a recovery. We expect consumer spending to remain solid during 2019, because all of those concerns, or almost all of them, are gone by now. The shutdown is over. Trade war with China looks less likely to accelerate. stock prices are almost back to where they were in late 2019, 2018. So we think that the fundamentals of the ability and the willingness of consumers to spend, we will go back to normal and grow at around 2.5% for the rest of 2019.
So the data has been pretty noisy. It makes it very difficult to kind of see. But most of them are because of temporary factors.
Yeah.
Would you expect that level of noise to continue in the rest of the year?
That level of noise, I would be surprised. But you know, we are almost a few months away from breaking the record for the longest expansion in U.S. history, and I think there is kind of a feeling during this time that this expansion has to end at some point. So I think all kinds of events that 5 years ago would not have caused much concerns are in such a sensitive period will create more noise. I expect more noise than usual, but what we had in December was really unusual. I don't expect that until the next recession.
So given that December and January were traumatic for consumers, what were they like for businesses?
So for businesses, we also had some drop there, but it seems, so what we have here is the ISM, the Institute for Supply Management. They have measures of confidence for both the manufacturing and the non-manufacturing sectors. And what we see is that we are seeing a significant, and what we think a true decline in the sentiment among manufacturers. We are still at a positive territory, above 50, but I think the trend is clearly down, and that is not surprising given the overall global slowdown in manufacturing. The non-manufacturing or services is holding up still nicely. There was a bit of a dip in December and January, but February we're back to very high levels. So I think that would signal that the economy as a whole is businesses are still pretty confident, but in manufacturing they are seeing some slowdown.
So this is one of the data points that I was thinking of when I said that we may be seeing a slowing cycle for manufacturing and industry rather than the non-manufacturing side of the economy, and that seems to be happening on a global basis as well, and it might be being affected by the global trade slowdown and the trade disputes that are kind of creating that noise.
Yeah, manufacturing is much more impacted by trade than non-manufacturing, so that would be consistent.
And it's also much more cyclical.
Yeah.
But when the services non-manufacturing dominates the share of the economies, then the impact of the cyclical impact is muted.
Yeah, yeah. And another thing to notice, we've been getting disappointing numbers from the housing sector for quite a while. But what we have here, the red line is the housing starts. In the blue line, we have the growth rate in the Case-Shiller home price index. So part of it, or perhaps the main reason for the disappointing growth rate in housing starts is that the homes in many parts of the country became much less affordable because we had a very long and consistent growth in home prices. So perhaps what we're seeing here, the slowdown in home prices, is a reaction to that. Hopefully, we will see a further pickup in the housing market because from a household formation perspective, there is a recovery. The labor market is allowing young people to form their own households, but they need affordable housing to manage to start their own household. So hopefully that is going to happen more rapidly in the coming year. So Brian, I know that you've done some thinking about the investment. So what are the main trends in business investment?
So I think the main trend to focus on for this month is what's happened in intellectual property products investment in 2018, when those investments, which include investments in R&D, investments in software, increased by more than 10% during the year. And of course, those are investments that directly impact the ability of firms to utilize new technologies to become more productive. 2004 through 2018 has in general been a period of slower productivity growth. Recent data have suggested that that situation may be improving, and I think that's absolutely critical in terms of sustaining this expansion, because as Gad rightly notes, the ability to hire workers at quite the same pace that we've seen over the past few years, that's going to be limited simply because the unemployment rate is going to be, is already much lower than it was, and so there are simply fewer outstanding workers. So in order for this expansion to proceed, productivity growth is necessary, and therefore continued fast spending growth, maybe not at that 10% clip, but fast spending growth in those intellectual property products categories is critical.
But Brian, I have to ask you, I think it will be an interesting discussion. Tax cuts, corporate tax cuts, didn't that impact the very rapid growth that we're seeing in intellectual property products?
I think it's hard to say exactly what impact the tax cuts had on IPP spending, for the simple reason that many of those projects are planned long in advance. It would have actually been advantageous for firms to do their IPP spending back in 2017 in order to be able to reduce profit levels that would have been taxed at a higher rate. And so I think the fact that it is harder to, there is some lag time between when those projects are initiated. It's hard to attribute a clear relationship, especially since a lot of the incentives in the tax bill relate more to spending on equipment, especially the depreciation incentives, than they do spending on research and development and software.
You know, it would have been a good poll question to ask this, but let me try to do a poll even though we don't have a poll. So if any of you can find the question pad, and we've been getting some questions, so I know it's there. If you can say, did the tax cut in late 2017, did that impact your company's investment in software and R&D? If you can say yes, it did impact, or no, it did not impact. Let's see, maybe there will be a few few answers. I'm getting answers, and well, I won't say not to bias you, but if we will see.
So software generally relates to the IT systems, but IT systems are employed throughout the company. It's not just the computers we use. Yeah. It would be software that's used in human resources or in finance. There's a lot of investment in things like robotic process automation and these types of automation, and using more big data and predictive analytics. Those all go under software.
Yeah. So I did get some answers, and it's 100% of the people who replied said no. So I guess the increase that we're seeing, Brian, you're probably correct. The increase that we are seeing in software and R&D is not a result of the tax cuts. There is also a question here before, what do we exactly mean by government spending, if the tax cut is part of the government spending. So no, government spending is only like direct spending on goods or services by the government. So it is not relates to things like taxes or transfer payments. It's just, so it's not all the spending of the government is just purchases of goods and services or structures.
I think the tax cut would show up in government revenues,
Yeah.
tax
Right.
receipts,
Yeah,
and also in the government deficit.
yeah, right.
Right, exactly. So, I mean, what this table shows here is that where government spending has been affected is from the 2018 Bipartisan Budget Act that was passed last February and gave the government more spending authority. And you can see that the effect of that will likely dissipate over the next few quarters since the middle of 2018, with the exception of the last quarter in general. Government spending has been much higher in terms of its growth than it would have been in the past.
Okay. So since we're in this table, what's our specific outlook for 2019?
So again, I mean, you can see that coming off of a really strong first half in 2018, there is a dramatic slowdown down through 2019, that fourth and first quarter. But then because I think the Federal Reserve has restored some confidence, it's going to be less of a slowdown than otherwise would have been the case. We're anticipating now 2.3% growth in the second half of the year compared with 2.1 or 2.2% that we had forecasted earlier in the year. So definitely Fed policy has had an impact there.
Mm-hmm.
So is it fair to say that the growth has kind of peaked and we may be kind of plateauing, right? So kind of generally on a slowing trend.
Yeah, I think that's absolutely a fair thing to say, that growth peaked very briefly in that second and third quarter. It's come down, but we don't really see evidence that it's going to drop below that 2% trend.
Mm-hmm. Good. So Brian, moving to the topic of monetary policy, you prepared here those four scenarios of what the impact of the Federal Reserve turn on monetary policy. Maybe you can talk a little about this turn and those scenarios of the impact of this turn.
So I think, first of all, what is the policy shift we're describing? Based on what the Federal Reserve was saying back in the end of December, I think most observers believe there might be 2 or 3 rate hikes that you would sort of see continued steady increase in the Fed funds rate, the policy rate, where there have been 8 increases since the end of 2016, pretty much on a quarterly basis all the way through. However, in January, Chair Powell stated that he would wait before instituting further rate increases until there was clear evidence that inflation truly was increasing. I think there was a lot of concern about global growth measures. In addition, since then, the Federal Reserve has also signaled that the process of normalizing balance sheets, that is, reducing holdings of Treasury securities and mortgage-backed securities, that process may be stopped at the end of the year. And that's another tool that the Fed now has at its disposal, this balance sheet of around $4 trillion in these assets, that by not reducing the balance sheet, it's going to mean that the supply of those assets is going to be greater than it otherwise would be. And so that's another tool making monetary policy more accommodative. So the question then is, what does this more accommodative monetary policy mean for business? And it's important to start with the most ideal scenario, the scenario that I think the Federal Reserve is seeking to trigger, which is that confidence, which had clearly been dampened in the beginning of the year, can be restored. And so that would mean a pickup in investment during the course of the year, less of a slowdown in growth as we've detailed, maybe a signal that labor market tightness may not produce additional wage growth, or maybe the process of transmitting that additional wage growth into price growth may be delayed. And in this scenario, faster growth, increased demand would not act to pull inflation higher. There might be other factors that are keeping inflation growth muted. And so the end result of that is that the Federal Reserve really didn't need to raise interest rates further in order to control inflation. So that's the most optimistic scenario. There's also a scenario that is detailed in the lower left, which is that this action may well be much ado about nothing, that will have a pretty modest impact on confidence. I think early returns suggest that this is probably unlikely, but also that because it doesn't have much of an impact on growth and demand, inflation ends up staying in control. I think where this scenario, if it did play out, would be more important would illustrate that the character of the economy has shifted, that capital firms are less capital intensive than they've been in the past, that maybe there are slower growth dynamics in place due to changing demographics in the US economy towards an older population, and that fact is relieving pressure on capital markets. And so therefore, the demand for capital is lower, and overall growth dynamics over the long term are likely to be slower than otherwise the case might be. Now, there's also the possibility that this action may, as some economists are concerned about, trigger increasing signs of upward pressure on prices and end up resulting in an acceleration in terms of inflation. That's what that upper right-hand corner suggests, that confidence is indeed restored. But then as inflation begins picking up, companies become concerned that capital costs may end up rising during the course of the year as the Federal Reserve is forced to boost up rates. 2 or more rate increases might well occur, and that's going to also mean falling profits because especially if those price increases are triggered by wage increases, that's not going to help profitability. It's going to lower demand, and so that's going to be a negative for growth. And then finally, there's the possibility that this could have no immediate impact on confidence, but also end up pushing up inflation. That could happen because of internal or external factors. So for example, if oil prices rise, that could put upward pressure on inflation. And the Federal Reserve would still need to raise rates perhaps twice during the course of this year in the second half. And that would end up meaning slower growth, slower investment, and that could mean that this policy measure could ultimately end up harming growth prospects going forward.
Thanks, Brian. And we'll just, because of time is ticking, I'll just let you take a quick look at the federal funds rate and see the increase that we've seen already in recent years, and it's still much lower than it used to be. Brian, what are we seeing in terms of the impact it had on the Fed policy on other interest rates in the market?
So you can pretty clearly see here the US Treasury rate began declining late in the year by about 50 basis points, and that decline was echoed in both mortgage rates and corporate rates. So that means lower borrowing costs for businesses as expectations about future Fed policy deteriorated. And that could end up helping the housing market. It could help big ticket purchases, especially autos, which would be critical because the auto sector is facing both domestic and global headwinds, and that's showing up in terms of lower sales. And so as long as the Federal Reserve is able to keep interest rates about 50 basis points lower than was the case going into the last part of 2018, that's definitely going to support growth as one of the reasons why we think that growth may be somewhat stronger during the last part of this year. Now, I think it's important to keep in mind two interest rate spreads in terms of thinking about the current state of the economy and risk to the economic outlook. So what this chart shows is the 10-year rate versus the Fed funds rate. Of course, when this relationship goes below that zero line, that's the dreaded inversion. That's where you can see in this chart that going back to 2005, 2006, the yield spread did become inverted, and eventually there was another recession. I think the key thing is to remember that it's not an immediate relationship, but it would be a signal if the 10-year went below the Fed funds, that there was an expectation that the Fed would be reducing interest rates sooner rather than later to combat future recessions. We're certainly not in that inversion place yet. We're also not in a situation where, and that also wouldn't trigger a recession for some time. Now, I think the corporate spread is probably the more important indicator in terms of where we are in terms of risks right now, because what this chart shows is the difference in rates between high-grade treasuries, so AAA rated corporate bonds and lower quality corporate bonds. And you can see that there has been somewhat of an increase in that spread, but not enough to trigger that there's a real deterioration in terms of sentiment about the level of risk. One thing that's been very interesting during the course of this expansion has been the remarkably small number of businesses that have gone out of business during the course of this expansion. And what this chart is showing is that so far market sentiment is for that trend to continue, and so there doesn't need to be a premium on riskier corporate debt for right now. And that's one of the factors that Chair Powell actually cited, that there wasn't evidence of rising financial risk. So I think the final piece is what is happening from an inflationary perspective, and what are the chances that inflation will actually rise as a result of increased wage growth?
Right, so let me take you to this slide. And I think, so what we have here is the employment cost index. So that's the most accurate measure, according to the government, of changes in wages over time. So that's the blue line, and the red line is the core consumer price index, so all prices excluding food and energy. So we are seeing a significant pickup in wages, and not quite at the pre-recession rate, but they're getting very close. The question is, are we going to see a pickup in the red line? In the past, in recent decades, the correlation between the blue line and the red line became weaker. We do see some, although in 2001 and in the late, right before the Great Recession, we are seeing some pickup in inflation. So the question is, will it happen again? I think on the one hand, when prices of inputs are going up, companies in many cases would pass the cost to the consumer. On the other hand, there are some opposite forces, like the strength of the US dollar, and the slowdown that we are likely to see in the US economy during 2019. So it's not entirely clear that that would happen, but I think as wages are moving up faster, the likelihood of inflation rising above the Fed's comfort zone is also rising.
So Gad, I have a question about this chart, and I'm not sure if I'm reading too much into it, but if you look at the slope of the blue line in the last 3 years or so, that shows a more gradual increase. And before the recessions in 2008, also 2001, you've seen sharper increases. The slope has been much steeper before recessions.
Mm-hmm.
Does that mean that businesses would have had more time to adjust gradually to rising costs, and maybe that's why we're not seeing a big sharp uptick in inflation?
That could be, but Adam, this would have to wait to another webcast because we are about to 1 minute away. So let's keep this, and maybe when we're here next time, it's a whole other discussion.
Sounds good.
Right before we finish, just to remind you that we have Economics Watch next month, as usual, and we have Brian Atman and I will be here together with Janet Howe, talking about innovation potential of occupation. So don't, you should be here. It would be very interesting. Also, we have an update of our global economic outlook, so you can go there. And finally, you can use this to get a $500 discount for the 17th Annual Change and Transformation Conference in June 13 and 14 here in New York. And finally, if you have time to take a quick survey to give us feedback, that would be great. We really appreciate your time here. Thank you, Ataman and Brian, and thanks to all of the viewers and listeners. Have a good rest of the day.